or the generally accepted accounting principles, require you that at the end of an accounting period, when you prepare the financial statements, at the end of an accounting period, the GAAP requires you to make an estimate of uncollectible amounts to be deducted from accounts receivable. I'm sorry about the spelling. It's receivable. So you should make an estimate of how much of your receivables may not be collected and reduce that through a separate account called allowance for doubtful accounts. Okay? So fundamentally, we are dealing with three types of accounts. So we have, in this chapter, we will be dealing with three types. So we have, on the one hand, you have accounts receivables. So what happened here? I thought these were new.
Want to borrow mine?
All right.
No, I was.
Extra credit. Extra credit.
Mine is 5 points.
For the class.
See, look at her. She's so nice. See, she's. Look at her. She's so nice. She's negotiating extra credit for the whole class.
Yes.
We're never going to forget it, Professor.
I'll be 80.
Thank you, Lord, Professor.
Yeah, get in that so we can go right up on board and permanent.
Permanent marker.
But I hurt my stomach.
Who said when in doubt, create an account? Good. I thought I said it once before.
You did.
You did.
Oh, nice. When in doubt, create an account.
We pay attention.
Carry
Extra
that.
credit.
See, that, well, there are certain old school, type of rules that I still carry with me. My father would always say, if something is very important to you, if I wake you up in the middle of the night and I ask you that, you should be able to remember it. So that's what it is. When in doubt, create an account. I have carried that all my 30 years of teaching. So it's a good thing to know, and it will come of use to you later on.
So we could wake you up in the middle of the night and ask you.
If you can. I'm a good sleeper. Okay. All right. Reporting. So this is how it will be reported. So basically, for example, here I picked it out from an actual company's balance sheet. On the balance sheet, in the current assets section, they have reported the total of accounts receivables at 2895. Allowance for doubtful accounts are 28, and they call this accounts receivable net. This so-called accounts receivable net, which is 2895 minus 28, is also called the cash receivable value. So you have accounts receivables less allowance for doubtful accounts, and this number here, this X, is also called cash receivable value or cash value. Cash value of receivables. So what do we mean by cash value of receivables? What we are saying is that this is our estimate of how much of my receivables will actually convert to cash. So if you have, like in this example, you have $28.9 billion in receivables, or $2.9 billion in receivables. Out of that, $28 million will, in your estimate, again it's an estimate, not be collected, and so therefore you are saying that converting from accounts receivable to cash, meaning that people will actually pay up, it will be only 2867. So the actual asset on the balance sheet is only 2867. Just like in the case of equipment, for example, we have the equipment at cost less accumulated depreciation. So when you subtract that accumulated depreciation from the equipment, then you are really reporting the book value of the asset. This is really, you can also call this the book value of receivables after deducting the allowance for doubtful accounts. All right, so now the question is, how do we do this? How do we operationalize this whole thing? Okay. Now there are multiple ways, but GAAP recommends one way. So or GAAP recommends actually two ways, but one way is the most commonly used. So we'll spend some time on that. Okay. So I just put it in words what that example said. This is your first year of operations. You have $500 of receivables at the end of the year. You estimate that 10 of the receivables will not be collected, so record a bad debt expense of 10 and an allowance for doubtful accounts of 10. So therefore, let's assume that you have $500 here. You are at the end of the year, you have not closed the books. Now what you do is you analyze the $500, and we'll look at how the analysis can take place. So you analyze the $500 and you estimate that $10 out of this will not be collected. So what you do is you first make that $10 as an expense. This is your first year though. Remember, that's the reason why. You make that $10 as an expense and put this on the credit side of the allowance for doubtful accounts. So now on the balance sheet, you will report the 500 minus the 10 or $490. These two accounts will go to the balance sheet. And on the income statement, you will see a bad debt expense of $10, which will reduce your profits by that. So on the income statement, your profits are lower by this $10 of bad debt expenses. Now, why did you need that? So essentially, in a broad, in a big picture way, of what you're doing is that you're sacrificing some profits this year to put them aside in a reserve to show, number one, to show under GAAP, to show that the cash value of receivables is not 500, it's only 490. That's number one. And number two, later on, if some customer would default and you have to actually write off an individual customer's account, at that point it comes out of here and not here. So the profits are not affected when you do an actual write-off. So for example, if I am the company and you guys are all my customers, so you all together collectively owe me $500 for the services I have already provided. Then I say at the end of the year, I look at, in some broad way, I look at all the accounts and I say, okay, fine, you know what, out of this $500, 10 will not come back. Okay, so I make this estimate, call it an expense, and I close the books, that year is done. At that point, I have not changed the 500. Nothing has happened to the 500. Now, let's say 2 years down the road. Let's say two of you who owe me, let's say $3. Totally. Between the two of you, you owe me $3. And let us say your companies go bankrupt. So at that point, I know that your two accounts I have to write off because you're not going to pay me the $3. So at that point, what do? I take it out from here. I use my reserve to the extent of the $3 that you are not going to pay me, and I reduce it from receivables. So now, at that point, my receivables have already become $497, and my allowance for doubtful accounts has become 7. Because I have now used this reserve. But the key point is that when I took away the 3 from your individual accounts and say, okay, this is not going to come back, or I close the 2 customers' accounts, at that point, it is not an expense. The expense was already, so I'm not sacrificing any profits then. The profits are sacrificed when I make the estimate of how much will not come back.
Is there a calculation for that ratio?
Yes, there is. There will be a calculation. It's not a ratio, but it's a calculation. This number has to be calculated in a logical way. And I'll go through that. Yeah. Anything else? Okay. So let's go through this example. Now, typically there are 2 methods. The one method is where, so the question is, okay, how do I come up with this 10? Okay. I can come up with this 10 in 2 ways. this is, no, we are not talking about the 3 now. So let's get rid of the 3. Write-off we will take later. Now the first point is to come up with this estimate. So as you say, okay, how do we come up with the estimate? There are really 2 ways of doing it. One way is to determine this 10 first as a percentage of this year's sales. Remember, it's an expense. So it's going into this year's income statement. So take this year's credit sales and say, okay, this percentage of my credit sales will not come back. That becomes your expense. Once this is determined, then obviously this is also determined. Because whatever you debit here should be credited here. So therefore, if you determine 10 as a percentage of the current year's credit sales, that's fine. That's done. That's one method. The second method is to go from here. Where you look at the 500 and say how much of the 500 will not come back and come up with this number here. You may come up with a different number. It may not be 10. It may be 12, it may be 15, it may be anything here.
You look at your income and you decide how much is not coming back to you?
The receivables, not income.
Oh,
The receivables, that's the second method. The first method is where you look at your sales and say, and just take a percentage of sales and make it the expense, and therefore that becomes your here.
The second one is what I'm
Second one is where you are determining this number first as it relates to here. You're not going by sales. You're going by receivables. And then because receivables is a culmination of all the past sales and collections. So you're looking at this number and saying, okay, what percentage of this number will not likely come back?
based on history of previous
Based on history. Most of the time it is based on history.
Okay.
Okay? So you determine this number first, and then what you do, okay, so once you determine how much should be here, that will determine how much will be your expense. Okay? So those are really the 2 broad methods. So I'm going to take you through an example that deals with both the methods.
For the first one, so it's like an assumption.
Everything, both are assumptions.
Okay.
Both are assumptions.
Okay.
So here is an example. So I will also use the key accounts on the board. And the example takes you through the tabular form that we went through during boot camp, but I will also use the key accounts for this. So let us assume that our accounts receivable starts with $400,000, and your allowance for doubtful accounts are starting with $10,000. So this is based on 1110, and this is also 1110. So you're starting the year with this. Now, let us say that you had credit sales during the year of $1 million. Okay? And you had collections during 2010, meaning the money collected from your receivables was $600,000, and you actually wrote off $15,000. So I'm going to take you through the tabular form to record these things, and then I will record it simultaneously in the T account form. So that way you'll have both. Okay. So the first step is to determine how you will record the credit sales. In the tabular form, what we would do is that we would increase accounts receivables by $1 million. That's the credit sales. And we will also increase revenues, therefore stockholders' equity, retained earnings, by the same $1 million. So the way we will account it using the T account system is that I'll go here. So I already have the receivables there, so I'll just put revenues. I'll put a T below that. So what we are going to do is we are going to record the accounts receivable of $1 million because it's all credit sales. It will increase your receivables, and at the same time we will record it as revenues. Okay. Now what I'm showing here in the T is consistent with what I'm showing there, but they are 2 different things. Okay. So those of you who are more comfortable with the T account system, you can see it on the board. Otherwise, you can revert back to what is there on display here. Okay?
Professor,
Yeah.
the red indicates what you're gonna get, right?
No, the red kind of color coding to say that that's a new transaction.
Okay.
So I just put a different color for each of those. So that's all. Yes.
And this is the allowance method.
No, this is the allowance method. Yes, that's right. That's right. All right. So then let's go to the now we know that $600,000 were collected. So when you collect receivables, what happens? Receivables goes down. Okay. So what we will do is, but at the same time, cash goes up. So we will record the $600,000 collected as a debit in the cash account and as a credit in the receivables account. Which is exactly what we have done here. We have added $600,000 in the cash column and we have reduced $600,000 from the receivables column. In the receivables column.
So why is that January 1st, 2010 instead of the next?
Say that again?
Why is that in the January 1st, 2010 column instead of the next one?
Why is the line item on your one-time?
No, I'm sorry. I'm sorry, I should put a date in here. This is throughout 2010. This is different. This is 1110 means all the previous uncollected sales is $200,000.
Okay.
This is the collection that happened. So this 600,000 may pertain to 1 million, to the 200, it doesn't matter really.
Okay.
So all we know is that when the 600,000 were collected, it came from either the 200 or the 1 million. So this happened throughout the year. I should put the date, you're right. So $600,000 was collected throughout the year. Okay. All right. So far so good? Any questions? Now, we will account for the write-off. Now, what do you mean by write-off? Remember what I said. If the whole class together, all of you as customers, your companies owe my company, let us say, whatever dollars you owe me. But then I determine that 2 of your companies have gone bankrupt and so therefore will not pay. So now I'm writing off those 2 individual accounts. When I write off individual accounts, what happens is your receivables have to go down. Because your receivables, the 2 accounts will go out of receivables. So your receivables will reduce by the amount written off. But the write-off does not come from profits as an expense, but it comes out of the allowance for doubtful accounts. Okay? So I'm going to put 15,000 here as a write-off. So this happened in 2010. I'll put 15,000 here. So I'm pulling 15,000 out of 10,000. I can't. But we will see how we deal with that. So I'm pulling 15,000 out of the reserve, okay, where the reserve itself had only 10,000. But I'm not going to wait on this until the reserve becomes big enough. I can't. The write-off must happen whenever you, as a business, decide to do the write-off. So if you decide that as of now, the money is not coming back, then you have to write off that amount. No matter what the reserve balance is at that time. Yes.
Usually, companies decide when to do the write-off based on the quarter or based on when they're closing the books, right?
That could happen. That could happen, but you don't have to.
So if I want to do a write-off in January and it just started the year or whatever the case is.
It doesn't matter. You see, the point is that you make that determination. The write-off should typically happen when you make the determination that that individual account is not going to get paid. Individual account. Now we are not talking big picture. Specific account, XYZ company which owes you money is not going to pay you. Once you make that determination, at that point the write-off should take place. But this 600,000 or this 1 million, this $1 million, that is not just one XYZ. It is like a bunch of companies with whom you have had a business dealing and they owe you money. Okay? Yes.
So if you're taking it from the 10,500, wouldn't that be left you give you with like a negative?
Yes. At this point it is negative, but we don't have to worry about it now. I'll tell you why. But at this point, yes, it is overdrawn. It is like you overdrew your bank account, checking account. But this is not cash, so you don't have to really worry about it. Nobody's going to say, hey, you know what, you don't have money, I'm not going to let you write off 15,000. Okay, because it's just basically profits that you set aside, but maybe you made a mistake in your estimation. Okay, that can happen. It's not a big problem. All right. So we wrote off $15,000, so that's done. Then what we do is, okay, so I just explained that here. So I'll go back. So now let's apply the first method. Both are estimation methods, but in the first method, what we are saying is that 1.25% of my credit sales is going to become an expense as a bad debt expense. So this year I had a credit sale of how much? $1 million. So 1.25% of $1 million will not come back, as will not be collected. So what is 1.25% of 1 million? $12,500. So I'm now going to say that my bad debt expenses are $12,500. So watch the sequence here. I'm saying this is $12,500. So because I have put $12,500 as an expense, I must increase my. I'm saying therefore that so when I put $12,500 as an expense, what is going to happen to profits? Profits are going down. So that's the amount of sacrifice in profits. So I'm putting that amount here in my allowance for doubtful accounts, $12,500. Now you can see this is in good shape. Why? Because it is 22.5 minus 15, so it's got a 7,500 into 7. So we are okay. So basically the point is that if it is overdrawn, you fix it at the end of the year, before the financial statements go.
So you write it off, and then you fix it at the end of the year.
Yeah, you write off anytime you have to write off. But you have to fix this account, the allowance for doubtful accounts, by adjusting your profits through an expense at the end of every accounting period. Meaning if it's a quarter, it doesn't matter what the accounting period is. If you do it quarterly, you have to do it quarterly. You have to do this adjustment quarterly. Any questions on this so far? Yeah, so
Are they always labeled account allowance for doubtful account?
not exactly the same way. Some people call it reserve for bad debts.
Okay.
It's just see in the United States the nomenclature is not mandatory. Okay, so reasonable, but this is the most common nomenclature. Allowance for doubtful accounts. That's the most common. If you read a lot of financial statements, you will see this name coming up again.
So rule of thumb, if the ADA is overdrawn, then you write off and you fix it at the end of the year, and then you by adjusting the profits by including in the expense.
That's part of the fixing. The fixing is that. That's exactly, you have just described the fixing part. So by fixing, what we mean is that we give up profits to make sure that this has got an adequate balance. At the minimum, it should have zero balance. It cannot have a negative here. So now this is having 22 minus 15 or 7,500 in the correct side.
If you have a negative, then you have no reserve.
That's right. Not only that, then the problem will be on the balance sheet. When you say accounts receivable, you will not be subtracting, you'll actually be adding the reserves.
Adding to
What is already there. So that's ridiculous.
It makes no sense.
Yes, absolutely correct. Absolutely. Okay. Yes.
This is just setting up.
It didn't say how to get that. I guess that's something to do. That's something to assume.
No, there is no question. I'm just describing the process.
Yeah.
Yes.
Alright,
Hang on,
so
everybody.
Oh, that's not on.
calculating that percentage,
Uh-huh.
can you just go over that real quick?
Yeah, the calculation of the percentage comes from, as she said, or I don't know, somebody, did you say that? Okay, from your past experience.
Because the
So
book
if your
doesn't
past
say, it just
no,
says.
there is absolutely no rule to any company. Basically it has to be consistent with your past experience. And if you find that for every $100 of sales, $1 or $1.25 is not coming back, that gives you the 1.25%.
Assuming a question like this is on a test, will you give us what that percentage is?
Absolutely, I will. Absolutely, I will. Well, this is not going to be on any test, just to put you at ease.
Okay.
This is going to be only in the online quiz.
Okay.
So
Alright.
So you're
Good reason.
yeah, and you have a book.
Yeah.
So don't worry about it. All right. Maybe I should not say you have the book. Don't worry about it.
No,
That's really the problem. I should stop saying that. Okay.
No, I understand.
That's a liability.
There you go. You got it. Absolutely. That is a potential liability there. Okay. All right, guys. Let's move on. Okay. So far so good. So now you can see. Supposing you had followed this method, and now you are at the end of the year. You have done the adjustment. So what will you report on the balance sheet? The balance sheet will report accounts receivables of how much? 1.2 minus 600 and the 15,000. I forgot to write it here. This 15 should be matched here too. So this is the write-off of 15,000. So 1.2 minus 600 minus 15. So I will report accounts receivables as $585,000 less my allowance for doubtful accounts is how much? 22.5 minus 15 or $7,500. So I would have 577,500, which is either you can call it net receivables or you can call it the cash value of receivables. So your balance sheet will show a cash value of receivables of 577,500, and your income statement will show with the revenues and all the expenses, it will show a bad debt expense of how much? How much will be the bad debt expense on the income statement?
$12,000.
Perfect. There's an account sitting there. You call it bad debt expenses. That's what will go on the income statement. $1,500.
Where'd you get the 7,500 again?
Sorry? 7,500 came from this. 12 plus 10 is 22.5 minus 15.
Okay, allowance for balance.
So this is the net balance here. The net balance is 7,500 on this side. So therefore that will be deducted here. 585 minus 7,000.
And where'd you get the bad debt expense? I don't understand.
It's right here.
Right there.
Oh,
That
that's
percentage.
thank you.
You just took an extra percent.
Sorry?
You just took a percent.
No, 1.25%. We used 1.25% to come up with the 12.5. And that's what goes on the income statement as an expense.
Do you use the?
Yes, sir.
I thought the account receivable was 600,000.
Why? It cannot be. Because when you write off, that has gone out. I mean, think about this. Let's say you have 30 accounts.
So
30
you take the
accounts.
15,000 minus the 600,000.
615. 1.2 minus 0.615.
He just did that.
Sorry, I'm not getting that.
Listen. In the receivables, on the debit side, that is on the increase side, you have 1.2 million.
Right.
So how much is receivable at this point? 1.2 minus the 6 that you have already collected, that is 600,
Right.
minus the 15,000 that you wrote off,
Oh, okay.
585.
Plus this side minus this side.
Okay.
Exactly. That's right. That's right. That's it again.
I said it's actually he didn't do the math. It's plus this side minus that side.
Yeah.
Yeah.
So you added.
Yeah, because debt's up here.
Yeah, exactly. You set off one side against the other.
Yeah.
And then 12,500 you added from.
Yeah. So it's plus this side minus that side.
Professor, so when you
Only for assets. For liabilities, it's the opposite.
so in what case do we use the 1.25% whenever we are short on the allowance for?
No, it doesn't have to be short at all. The 1.25% works no matter how much you have already drawn. You really hit the nail on the head. When you estimate your expenses as a percentage of sales, you are really not considering the fact that this is overdrawn or underdrawn. Remember this, I mean the 1.25% and the $1 million are completely independent of this situation here. See that? So therefore you really, you're not considering this at all in coming up with that number. All that happens is that once you determine that number, that kind of shores up your reserve. By whatever number you come up with, that increases the reserve, and hopefully, and even after this, it is still on the other side, then you have to do more, obviously. Okay? So you can't say 1.25 and then still leave this on this side. You can't do that. So the 1.25 must go up to 2 or 2.5, whatever. Okay, any questions on this so far? Now I'm going to go use we are still in the same regime of estimating receivables, but this is the method that IFRS requires you, the one that I'm going to do now. Okay, that's a method that is required under IFRS, and US GAAP allows both methods, but IFRS requires only the method that I'm going to talk to you about now.
So the IRS
what is
is
it
only if
called?
we live in another country.
Yeah.
Okay.
And you know, the way things are going, I mean, the US GAAP and IFRS will soon converge very quickly. I think it is going to be very quick. I mean, you know, we keep hearing about this IFRS all the time, but now I'm seeing that in China, for example, yesterday somebody was making a presentation. China, apparently, in mainland China, they have what is called as China-based IFRS, and then in Hong Kong, they have what is called as Hong Kong-based IFRS. So all these countries who are claiming that they have implemented the international standards, they are not implementing it completely. They are basically modifying their existing standards somewhat to kind of incorporate key features of the international standards and still leaving intact their own country standards. So we really don't have the 100% IFRS truly. We have 95% IFRS in every country which claims to have implemented IFRS. So my answer to your question is, even though IFRS prohibits it, a country can override that. They can simply say, hey, you know what? Yeah, we will use both methods.
Professor, since you have so much knowledge in the area, you think inventory is going to change too? The way that they do inventory?
Yeah, I think it will change. Why? Because the reason why, no, I think the IFRS will change, not the US GAAP. The US GAAP is not going to change. I think that the reason is that IFRS does not permit LIFO right now, and that is going to change because there are in a number of countries, even though IFRS does not permit LIFO, the tax law permits LIFO. Germany, for example, for tax purposes, you can use LIFO. So therefore, since there is predominant usage of LIFO in those countries, I think it is the IFRS that will back off and say, okay, fine, we are going to permit LIFO. That is the more likely scenario. But in other cases, most probably the US GAAP will change. But on inventories, I think the significant change is going to come from that. I think so. But again, these are all politics. So, half the time I don't know what I'm talking about.
What is the name of this next method?
It's the same thing. It is still the estimation method, but now the estimation is based on receivables, not the credit sales. Question?
I'm sorry, I missed how you got the 577, 500.
Oh, 577, 585 minus 7,500.
Oh.
Where's the
You said
75?
it, yeah.
Comes from
75 comes from here. 12 plus 10 minus 15,000. 12,500 plus 10, 22,500 minus 15 is 7,500. That's the allowance for doubtful accounts.
And where the 12.5 comes from? From the 6? From the...
bad debt. That's 1.25% of a million.
1.25% of the credit sales. That's what the problem says. The problem says you're estimating bad debts as 1.25% of the credit sales.
So you don't take that from accounts receivable?
That's the point. You do it at a broad level. Because if you are making new credit sales of $1 million, you are saying that 1.25% right off the bat is unlikely to come back. So therefore, you are immediately matching the expense of 1.25% against the new credit sales. That's why this number is getting fixed first. Once you put 12.5 here, then you have no choice but to put the same 12.5 here, and then completely rework the balance. It already had some balance. Now that balance is going to move based on the additional 12.5 that you have put here. But we came up with this 12.5 not here first, but here, as a percentage of credit sales. So this is where you have an income statement approach, where you say, okay, on the income statement, my revenue is $1 million, but my expense relating to that revenue, one expense relating to that revenue is 12,500, and that shores up my reserve, and so my reserve gets a new balance, which may not be 12.5, but it is only 7.5.
So it adds with the expenses.
All right. So now what we are going to do is we are going to change the method and we are going to do it in a different way. Now, aging of the receivables. So now this is the way you would typically do. How you would estimate your receivables is on the allowance for doubtful account is through an aging of receivables. So typically, what companies will do in that case. Okay, so now look at your accounts receivable. Your accounts receivable has 1.2 minus 6 minus 15. So we've got $585,000 in receivables. Okay. Now, what companies would normally do is to age the receivables. That means due for less than 30 days. Example, this is just an example. You could do 15 days, you could do 10 days. It just depends upon what your business cycle is. If you give a normal credit period of 30 days for everybody to pay, then maybe there is a bunch of it which is not due for for that amount. So due for less than 30 days, then 31 to 60 days. Let's say 61 to 90 days, and let us say more than 90, greater than or equal to 91 days. This is just an illustration of how we age the receivables. So now let me just split it up. So let's say due for less than 30 days is $400,000. Let's say from 31 to 60 is, let's say, $50,000. So that's 450. 61 to 90 is another, say, $70,000. Okay, how much is that? 400, 450, 520. We have 585. So this is, let's say, $65,000.
And you just pulling these numbers out in the air?
I'm sorry?
These numbers are from the air?
Just from the air. Yeah.
But they have to match.
Well, they have to match the 585. So I'm just splitting up the 585.
Oh, no, that I understand. I'm just saying the way you're allocating the money.
That is out of the air. Yeah, out of thin air. You can change this in any way you want. As long as it is adding up to 585, you're okay. Then what you do is you get a probability that you will not collect. This is how typically it is done in most businesses. And I don't know. I mean, those of you who are aware of this, you can correct me if I'm wrong. But my understanding is that this is the way it is mostly done. So probability that you will not collect. Let us say that if it is less than 30 days, you think it will be collected. So let's put 0 here. Okay. So let's make this 31 to 60. Let's say it is 10% chance that you will not collect it. Okay. So that's 5,000. Let's make this 5%. Okay. So that is how much is it? 2,500. Let's make this 10%. It's okay. I'll just put 10% and then put 28. Okay. So basically, it's an increasing number. That is, the more out it is, the more chance that you will not collect it. Okay. So at least even though the numbers may be off, but basically the trend is obvious to you. This is how typically it is done. So therefore, expected not collect. So now how much will you not collect or expect to not collect? So it will be 0 times 400, that's 0. Then 5% of 50,000, which is $2,500. Then 10% of 7,000, that is $7,000. 10% of 70,000, sorry. That's $7,000. And 20% of $65,000, that is $13,500. So what's the total here?
15,500.
How much?
7,000. And 2 like 500. 13.
23,000.
No.
That's the total amount that you will expect to not collect. Okay. So you go through an exercise like this to come up with the amount that you may not collect. Yes.
I got 13,000 or 20% of 65.
Yeah, that's correct. Or 13.
Yeah.
Of course, you should get 13. Thank you. Absolutely. This is 22,500. Thank you very much. 22,500. Thank you. So we have. So it will be 2,500 plus 7 plus 13,000, which is 22,500. Is that right? Is it 22,500 now? I hope I'm not wrong. 13 plus 7, 20, 22,500.
That's right. Yeah, that's right. That's right.
So you go through an exercise like this and you come up with this $22,500. Now once you fix the $22,500, now we got to remove the 12,500 because it's now a different method. Okay. Now what we are going to do is we are going to say that this needs a balance equal to 22,500. That means you need 22,500 on this side net.
Oh, okay.
Because we know that this 22,500 is what is to be matched against the 585. We did an analysis of 585 and we said out of the 585 we expect 22,500 may not get collected. Now, where are we on this? We are actually 5,000 on this side. So how do you go from 5,000 to 22,500 on this side? You need a plug-in figure of 27,500. Because if you have 27,500 on this side as a new number,
It's 15,000, Professor.
what?
It's
On the other
15,000.
side is 15,000, not 5,000.
No, he says you need.
No, but you have 10,000 already.
10 and 15 net together, you are a balance of 5 here.
Oh,
Yeah.
So from 5 here, you need to come to 22,500 on this side, which means that you need an additional 27,500 on this side to move the balance to 22 here.
Can you just go shopping?
So you need 22,500 on this side based on your analysis of this. So we need 27,500. Now how do you get the 27,500? You get from here. So you sacrifice $27,500 of profits this year, put it all in the reserve to get the reserve to 22,500, and now you're done. Now what happens is that the allowance for doubtful accounts becomes 22,500, and so therefore this will be what, 500, 2, 6, 562, 500, and your bad debt expense will be equal to 27,000.
Okay. So you're crediting the allowance of doubtful accounts by 22.
No, 27.
Well, no, based on your formula of aging of accounts receivable, you came up with that we were crediting it 22,500 on top of what was already there, right? What with the balance?
No, we needed it to be at 22,500.
15,000 minus 10,000.
we needed the balance at the end of the period because at the end of the period we had $585,000 in receivables.
Right.
That number is not going to change anymore. The write-off has already happened, everything is done.
Okay.
So we are starting with the 585. Then we kind of split the 585 into different silos. And in each silo, we put a probability that we will not collect that particular silo. And based on that, we came up with the 22,500.
Correct.
So therefore, the number that needs to match against the 585 is 22,500. But the number that will match on the balance sheet is whatever is the balance here. This is the number that will go. You cannot have a number here and then say that will directly go to the balance sheet. It has to be reflected in the account.
Okay.
So this account needs 22,500 in balance at the end of the period.
And currently it has
It
5,000.
has 5,000 on the opposite side.
Uh-huh.
So to bring the 5,000 from the opposite side to 22,500 on this side, you need to put an additional 27,500 on this side. Because that will take care of the 5 and it will give you an extra 22,500. So that now the balance will be 22,500 here. And this 22,500 will go to the balance sheet.
So
But in order to get to the 22,500, you need a 27,500 here. And that cannot come from thin air, it has to be an expense. So you will sacrifice $27,500 in profits in order to bring the balance in the allowance for doubtful accounts to the required balance of 22,500.
And then you subtract it from the 585.
The 22,500. This is the number that will go against the 585.
But how did you determine the 27,500?
That's
You add everything, you minus that. So if you get $10,000.
That one was 22,500, not 27,500.
No. Well, that is 22,500.
Right.
But if it is 22,500, so we needed 22,500 here. But we already know that it is 5 on this
It's like
side, so we
Tanya
needed
said.
27,500 here.
You get 10 plus the 2250 minus the 1500.
How do you know you need 27,500?
Okay, think about this. Let's call it x.
Yeah.
Okay.
So 10 plus x minus 5 should be equal to 22,500.
Okay.
Solve for x. That's
Okay.
your 27,500. Right? So it is like the fill-in amount. And the fill-in amount cannot come from nowhere, it has to come from an expense. So basically what you're saying is that this period you will sacrifice 27,500 in profits in order for the reserve to reflect what you have already determined it should reflect. If you don't sacrifice the 27,500 in profits, your reserve will not reflect the 22,500.
So if you collected it, just goes back.
Yeah, we'll get to that later. We'll get to that. But first, I want this to sink in. So basically, at this point, it should be clear to you the difference between the two methods. So broadly speaking, the two methods differ in the following respect. In the first method that we did, the 1.25% method, in that method, well, anyway, this 27,500 is not what I'm showing in my example. In my example, the equivalent to the 22,500 is actually 11,700. I just did some analysis there and I came up with 11,700, which is possible. I mean, it doesn't have to be the same for every company. So I came up with 11,700. So now, whatever it is, assuming that we did all this analysis and came up with 11,700 here, right? If we came up with 11,700 here, then what we are saying is that we need 11,700 here. So this will become 11,700 plus the 5, 16,700. So if, for example, in my PowerPoint example, if it shows if my analysis here shows
Now you're computing numbers from the 5.
yeah. Now I'm just changing the number based on the PowerPoint. So if this shows 11,000, good. So if I need 11,700 here, So I'm going to need, the plug-in figure should be 16,700. And so my expense here would be 16,700. So I put an expense of 16,700, shore up the reserve by 16,700, and so I'm ending the period with 11,700. Yes, sir.
So in this example, you're using 2% of that.
Yeah.
Why did you do this other breakdown? Is there any reason? Should we do it this way, or should we just?
This is the right way to do it.
That's the right way to do
I
it.
just made it easy for myself.
Okay.
I just simply said, overall it's 2%. Well, remember this. I can always generate the percentages in a way that will end up being 2% of the total. But that's a mathematical exercise. I can given about 5 minutes, I can come up with numbers here that will work that way. Think about it. This is simple answer is this. Once I have all the numbers here, I can just put 0, 0, 0 for everything and just fix the number here in the last column to make it 11,700. It doesn't matter really.
Right. Okay.
So, but the point is that this is the right way to do it.
So, okay, that's the right way.
This
to do
is the right way to do it.
And always using that percentage amount. Is that?
No. That percentage number has to come from your business. Every business will have its own percentage.
Gotcha.
For all you know, your business might actually be working on extending credit like crazy to everybody. In order to improve your sales, you may be growing through extending a lot of credit. If that is the case, then you may actually be in a situation of 0, 0, 0, and only beyond 90 days, you think that there is a possibility that it will not come back.
Okay.
So you may have a bunch of customers who, even though they are buying on credit for 30-day period, they will pay in 90 days. So you may actually end up in a situation where maybe, in fact, you know what, you gave me a great idea. Can somebody tell me what is the, what is, okay, do a calculation for me. 11,700 divided by 65,000.
0.18.
How much?
0.18%.
0.18?
Yes.
So 18%? Okay, so let's do that. So let's say we'll put a 0 everywhere.
And 18%.
I put 0, 0, 0, and instead of 20%, I put 18%. Now you have your 11.7, right?
Yeah.
So now you know that you need 11.7, and for your businesses, for your particular business, you might be actually on a 0, 0, 0. But for a different business, they could come up with let us say 0 here, some number here, and increasing number here. So it may not be the same for every business. So now quickly we have now made this example consistent with the one in the PowerPoint. So now we are expected not collect would be equal to $11,700, and so the $11,700 is the balance that is required here. So therefore, you need $16,700 in bad debt expenses in order to get the balance to 11,700. No, there is no hanky-panky going on. So if you think that I'm doing some hanky-panky, I'm just making it easy for myself. What's
That's
that?
why you said your hanky-panky for the test is not fair.
It's very easy. Whatever percentage that you identify there, you just gotta sum it all up. You gotta plug it down here, and then you find a difference.
See, he's got it. That's all that is.
Because you can put whatever percentage you want.
Look, you want to start here.
Put whatever
You want to start here. Put the percentages here.
and you just sum it. The percentage times whatever amount it is, then you sum it up. When you get the expected amount to collect,
I don't know.
you put it down here in the bottom of ADA,
And
and then you look for the difference.
But
then you gotta figure out how it got there.
Come in 18% instead of 20%, 25%.
Yeah, that's because it's unique to every business.
That's up to you.
Oh no, but it's right there after all that.
It's your
So
business.
once you figure out what the business is, then you could either like allocate it throughout the year or days or whatever it is, or just put it in one day.
Right.
Okay.
Not one day, in one silo.
On one
See,
side,
the
right.
point is that most businesses will have to do an analysis that goes by every 30 days.
Okay.
So now my only point is that your experience in collecting money from your customers might say that, all right, up to 90, even though the customer is buying on a 30-day credit, they almost always end up paying within 90 days. So up to 90 days, I have no fear of not collecting the money. But I have this information with me. I know how much has been due for how long. So later on, if the business conditions change, I can start putting numbers here. But right now, my situation is that everybody is paying up to 90 days. So I put a 0 everywhere. Beyond 90 days, my estimate based on past experience has been an 18% chance that they will not pay. So therefore, overall, given my current composition of receivables, I am expecting that $11,700 may not get collected.
Okay, so now you have to make it match on the allowance for doubtful debt account?
Yes, that's right. So therefore, the point is that once I determine the 11.7, that should be the bottom line number here, because this number goes to the balance sheet.
Okay.
So on the balance sheet, I need to show this 11.7 as uncollectible allowance for doubtful accounts,
Okay.
because that's what is matched against the 585. Remember, I started with the analysis of 585. So against 585, I will match the 11.7. But I don't have 11.7 in this account. What do I have? I have -5. So to go from -5 to the 11.7 that I really need here, I need an additional 16.7 here. Right? So now this 16.7 cannot come from nowhere, so it has to come from my expense. And expense means profits are going down. So I will set aside $16,700 in current year profits to shore up my reserves to the 11.7, which is what I need for the future write-offs.
So you take 11.7 out of your receivables.
Well, not out of your receivables, but you subtract it from the receivables, because it's a separate account. Your receivables is still showing 585. Remember that. This number is only 585. The 11.7 is a separate account. It's a separate account on your financials.
That's the balance of the
So
account.
there are.
That went into your.
Yeah, it is matching against the receivables. So you subtract the 11,700 here. So we have 300.
And you add it to the.
6.3 and 573.3. Is that right?
Mm-hmm.
Okay, 573.3, and in the income statement, the bad debt expense will be
16.
perfect, 16,700. Yes, sir.
Now, does that account for interest rate as well, or is that separate?
Which
Say you're
interest?
collecting over 90 days
Mhm.
with an interest rate.
Typically, there will be no interest for accounts receivables. If you want to go from to collecting interest, then the accounts receivable must be converted to what is called notes receivable. In the notes receivable, you can actually charge an interest.
Professor,
Yes.
my own character. The bad debit expense, right? That comes from your revenue, right? When you're writing the books.
No, it comes on the income statement as an expense. It's not. I don't know what you mean by coming from revenue. It just is
So
an
at the
expense.
beginning, the way I understood what you said, right? At the beginning of the year, you have the book started with 585. You want to make sure that you have allowance for that.
No. The year didn't start with 585. The year started with $200,000.
Okay, so we have $200,000 in investment when we started the year. We want to make sure that we have money allocated for the allowance of bad debt, right? So that we start with 200. We could come up either with 10% is one way. We could come up with a certain number based on our history is another way, or we could do the calculation, the aging calculation, no?
The 18 is a substitute for the different things. So I just changed these numbers to 0. So those are the same thing. There are only two ways.
I'm trying to understand the complete from beginning to end. So if we started our account with 200,000, do I want to allocate money from there to the allowance of doubtful debt, right? To make sure that there's money that won't affect my revenue and it'll still have it won't affect my profits is the word you use.
No matter how you allocate it, it will have to affect your profits. The money is coming from the current year's profit because it's an expense. The question is how much. The how much will change depending upon whether whether the expense is a proportion of your sales, that's a 1.25% example, or the balance here is somehow related to the 585. Depending on which way you go, the amount of the expense will change. In every case, it is always an expense and it is coming out of profits. Okay. Any questions on this? Okay, this is the most conceptually difficult part of this chapter. The rest of the stuff is pretty straightforward. I mean, for the quiz, you should, with an open book and my sample quiz, you should be able to figure it out. I mean, the rest is not very difficult at all. This is conceptually the most difficult part, and that's the reason why I spend class time on this. But again,
Professor, the time for the quiz is very short.
It is too short.
If you have to calculate all these things.
Okay, how much do you want for the quiz?
It's another half hour.
Another half hour?
Yeah.
4 hours.
But if stop, don't make them, it's not a joke, seriously. Like,
No, it's not a joke at all. I'm not treating it
an
as
hour and a
joke.
half to 2 hours is really,
It's not a joke. Yeah, because
Okay, what do you want? You want 2 hours?
2 hours,
Yeah.
please.
At least.
2 hours? For any quiz that is not yet complete, I'll make it 2 hours.
Thank
Is that okay?
Yeah, because
I'll change the time to 2 hours.
Can we get a second attempt if we already completed in advance? Please? Like, I worked in advance, but I ran out of time on the last one, so. For having a second attempt.
For what? For the ones
No,
beforehand?
that's not going to factor into my consideration. How many of you, now which quiz are we talking about? Quiz 3, right?
Yeah.
How many of you have already completed quiz 3?
What?
No,
No, I haven't.
we've only done 2 so far. We've only done 2 so far, right?
No one.
Okay, now
You can't go in.
there's only
I
one
know.
way I can do this. There's only one way I can do this for you. I can reset your quiz, which means that whatever score you already have is zeroed out.
That's fine.
So only the new attempt that you take, so it will not be the best. This is important to understand. If you've already done the quiz, remember 2 things you have to consider. Number 1, you've already done the quiz. You think carefully about how much points you already got, and also think about the fact, I don't know your scores, I can look it up, it's not a problem. You think about how many points you've already got, and also think about the fact that the bottom 3 scores are dropped. Okay? Consider both, and then let me know if you really want your quiz reset, because once I reset it, your score goes away. And with the 2-hour time limit, whatever you have is what you have. So if that's what you want to go with, I'm okay. I don't have a problem. It's just the 2 of you. I can always have it specially reset for the 2 of you to give you 2 hours. But it will mean that the old score has gone away. So send me a message individually to see if that's the way you want to go. Oh, okay. You haven't taken it. So it's just one person. So you send me a message separately to see if that's the way you want to go.
What time?
Yeah.
How did you do?
You have projects? You don't have anything?
Way ahead.
Do it.
The third series that you've done.
You could do better with 2 hours. How long is it going to be?
No matter how I do that.
Okay.
Even if I do what's that 167? Is that 10-5? Is that 10-5? That's just a straight 10. There's no 5.
That's 10. This is 15,000.
Okay.
So that's a negative 5.
I have that's what's messing me up. That's why there's a 5. So you have 15,000 over here, 10,000 over here. Then you have 167, which I understand is you have to make.
This is the required number to get that.
Yes, I know you have to transfer this here. Figure out how. So how did you figure out that 167 using those 3 values? I need to see the math.
Think about it. Okay, I'll do it as a math.
Yeah, I'm a visual. I haven't
Okay.
seen that.
Okay, you want to see the
I
math?
want to take that little space to do that. I don't see the math. I don't get it. Yeah, I have to see. I mean, I understand the concept. I just have to see how it's getting.
What's the levy something?
See, I have to. That's what I have to see.
Whatever you put on there, and you put down there, you
So
guys
it's 11,700. So it's 11,715.
Okay. Okay, so here we go. So we have 10,000. Okay. You have the 10,000 on this side. Then you are going to add something, we'll call it X.
Okay.
We're going to determine that X. Okay? Then minus what you already have on the left hand side, the debit side, 15,000.
Okay.
And we want that to be equal to 11,700.
Okay.
Now you're going to solve for X.
Okay, then I can go. That's what this is the part of the class that, you know, I didn't have any accounting, so for me, it's like, if I don't see the equation, I don't know how you got it.
Okay, perfect. Now
that I can see it, I can always do it.
Yeah, that's the thing. But there are going to be very few equations in this course. I mean, think about a balance sheet equation plus, something like this where you have to settle the balance.
X minus 5,000, and you add the 5,000.
Now, these are two different methods. Is there any reason why we would choose one over the other?
Yes, that's a good point.